No,
Okay,
I
good.
was going to stay on video just for a second to say hello to everybody. I will go off video to do my screen share for the slide presentation, but I love to see everyone, and I want to thank everyone for joining today. This is one of my favorite agency calls to be on, so thank
Awesome.
you for having me, Charles.
Well, thanks for
All
thanks for
right, give me
helping
just a
us.
second.
Hmm.
Oh, no problem. Let me get set up here. Go full screen here. Hey, Charles or Alonzo, can you
Yes.
all see my slide presentation okay?
Yes, we
Yes.
can. Hmm.
Lovely. All right. Well, what I was charged with today was covering our annuity portfolio. This is something that, for a lot of my 10 years that I've been here at Ameritas, we were in a really low interest rate environment, and a lot of people really weren't talking about annuities. So now that we have seen rising interest rates, it has really been a new topic of conversation as of late. So what I will do is for real quick for any of you on the phone that I haven't connected with, I think I have pretty much every single person on the line, I believe. If not, my name, my number, and my email address is listed on the slide in front of you. Oh, excuse me. Plus, please remember, our sales desk is always available if I am not. If you need something real quick, don't hesitate to reach out to them either via email or phone if, again, I am not available. As a matter of fact, I will be leaving on Friday. I am taking, along with my husband, we are taking my mom to Hawaii. So I will be on a little PTO through the rest of the month. So, for example, if you needed an annuity illustration and I'm in Hawaii, feel free to call the sales desk. Okay, so with our annuities, the first thing I want you to know is in the state of New York, as well as the rest of the country, we do have our immediate annuity. Outside of the state of New York, we have our Accumulation 7 and our Income 10. Those are both indexed annuities that we're going to talk about today. With immediate annuity, I did want you to know that this is something that is available for your clients up to age 85. It does require a minimum premium of $5,000. And what this will do is turn that lump sum that your client gives to us into immediate income. This is something where there's really not a deferral period. This is someone who has a sum of money who would a predictable, steady, guaranteed stream of income, whether that's lifetime income for an individual, whether that's joint life expectancy for two individuals, whether you're looking at a fixed period, whether you're looking for a combination thereof, or a life payout with some certain premium guarantees. These are all different ways you can slice our immediate annuity. It is something, like I said, where if your client has that lump sum of money and they're looking for a predictable guaranteed income stream, an immediate annuity would be something you might want to look at. Please remember, this is available in all 50 states, including New York. With our immediate annuity, you may have it where someone has, again, some need for extra income during their early years of retirement. We're seeing people use immediate annuities for those first few years. There's also non-retirement needs, such as using those payments to cover maybe living expenses for a college-age student. Really, any situation, like I said, where that steady guaranteed income is something that is needed for the client. In this New York, we do have one other product available. This is our Compass FPDA. Please note this is a New York only product. It is not indexed at all. It is something where the company sets the interest rate. I did quick look it up before our call, and the base rate on this is 3%. Might not sound like a very high interest rate. It's not, but it does have a 3% guaranteed rate on it. So we know that the renewal will never be less than 3, and that they are guaranteed to earn at a minimum that 3%. So maybe for your client that has some funds that they would like to diversify into more of a safe, again, non-indexed bucket of money that is still tax deferred, this is something that the Compass FPDA might be of interest. Again, tax deferral definitely being one of the #1 reasons to look at our Compass FPDA, along with guaranteeing that principal investment. We know that the client will never lose any money on this contract. And again, as of today, when I looked up the rates, it was guaranteed at 3%, which is not a bad contractual guarantee if you ask me. The other thing that's nice about the Compass FPDA is it is a lower minimum premium product. Now, you will see this in relationship to some of the other annuity contracts that we offer at Ameritas or other annuity, contracts with our competitors. Usually you see much higher requirements for that deposit dollars to get the contract started. Ours, as you can see on the screen, are pretty low. $100 a month for qualified monies and $200 a month for non-qualified is pretty low. The other thing you want to know, it is an 8-year surrender charge product. That is something that means that if the client needed to liquidate the funds, besides their 10% free withdrawal that would come out without penalty, there would be a surrender charge that would have to be assessed to the contract during the first 8 years. After the 8th policy year, they are free of surrender charges, and they can do with those annuity funds as they see fit.
Quick question, Kristi. I
Yes,
might
sir.
be getting ahead of you here. I see we have
No, you're
the
fine.
SPIA, and I see we have the flexible premium. Do we have a SPIDA too?
We do not. You could use, in New York, you could use the Compass FPDA as an SPDA. There is no requirement that you have to make anything beyond that minimum premium payment for the first year. So if you have someone with a lump sum, as long as they met, let's go back a slide, as long as they met the minimum single deposit requirement. So again, qualified money, $2,000 is a very small minimum requirement. Non-qualified money, $5,000. So Alonzo, you could use this as an SPDA in the state of New York, and please remember that 3% guaranteed rate that we're offering right now is something definitely to take a look at. Great question. You bet. A couple of the things that we like to point out, what would somebody looking for a guaranteed interest rate, like I mentioned, right now it's at 3%. That is something that's subject to change once you're looking at purchasing the contract, you're locked in. So I do want you to know that the 3%, if you bought it today, you're locked in at a 3% guaranteed interest rate. Now, that doesn't mean that we'll have a 3% guaranteed interest rate next month for new clients into the contract. So I do want you to be mindful that it is a rate that varies, but once you purchase it, then you're locked into that guarantee. The other thing is, if your client's looking for safety of principal, tax deferral, and really something that is conservative for your clients to maybe, park some of their retirement dollars that they don't need now, but they want it to earn a safe guaranteed rate to use for their retirement income, this is something you might want to look at. And again, available only in the fine state of New York. Okay, any other questions on the New York only product? Because what I'd like to do is spend the time going over our indexed annuities that are available outside of New York. Questions on the New York product? It's pretty straightforward.
Question, how long is the 3% locked in? Say I'm working with a client Do the funds have to come in by a certain time to lock in the 3%, or is it based on the date of the application?
It is going to be, they are going to put it in at application date, Charles. So that is something that, again, be mindful that the rate can change on a monthly basis. I don't see that one doesn't fluctuate a lot. I've seen it kind of hovering around that 2.75 to 3% range for the guarantee for the last few months. Now, that doesn't mean it can't change, because again, we do look at that rate every month, but you would have to get the application in to lock in that rate.
I mean, does it change at the end
Great
of the month
question.
or the beginning of the month, or is there
They
a date?
declare what they do. Yeah, it's beginning. Yep, when we declare interest rates, they are good for the first of the following month. So right now, that 3% guarantee is on our March 1 rate sheet. So if y'all go to Producer Workbench and go to Rates and Performance and click on the annuity rate line, is what the document is called. The annuity rate line does have that Compass FPDA New York listed for the March 1st rates, and it is that 3% guarantee. So it's at least good through the entire month of March. That I do know.
Okay, thank you.
Yep, great question. Great question. Well, we'll go ahead and pivot over to the accumulation 7 and the income 10. These are our indexed annuities that are available in the 49 states outside of New York. We do not, as I've mentioned, we do not have any index annuity approved at Ameritas in the state of New York, but I know a lot of you have clients and reside outside of the state, so I want to make sure that we go over what we can offer. So first of all, with our indexed annuities, we do have a minimum premium of $10,000. Remember, I said with the New York annuity, it had very low minimums. You'll note that our indexed annuities have minimums of $10,000. What happens is the rate that your client is going to receive will be dependent on what that premium deposit is. So the higher the funds are that you deposit, the higher rate band that you can qualify for. We have a minimum rate band, a low, a medium, and a high. When we're done with the slides, I can quickly bring up a rate sheet so you can see what that looks like in Producer Workbench. These indexed annuities offer waiver of surrender charges if certain things happen. So for instance, these are no-cost riders, by the way. If your client is confined to a nursing home, a confinement facility, unable to do the 2 of 6 ADLs and are receiving home health care, if they become terminally ill, there are 3 different ways that you can basically ask for a waiver of surrender charges if your client needed full access to their annuity. Also keep in mind that both of those indexed annuities offer a 10% free partial withdrawal, and that is after the first policy year. So just note that we do have some liquidity, kind of like exit strategies available for your client if maybe they're a little bit older and maybe they're concerned about tying their money up, because obviously with annuities, there are surrender charges assessed to them if you surrender during that surrender charge period. We know that some things happen in life and that your client might need access. And again, if it's one of these triggers, we would waive those surrender charges. So please know that. We have a variety of index strategies available on both of our index annuities. The most popular is the S&P 500. I'm not going to kid you. It really is, and that very first line, the 1-year point-to-point, I think that still tends to be one of the most chosen options with our index annuities. We do have a variety, whether you like a 1-year or a monthly average. Maybe you like something that doesn't have a cap rate but offers participation rates instead. We do have our sector rotator. I've got a couple of slides on that. If you're looking to diversify outside of the Standard & Poor's 500, we do have the Russell 2000. That's, you know, an index that's based off of small caps instead of large cap companies. And then we have an international index as well. The S&P sector rotator strategy, this is one that is a no cap option, and people will ask how it works. So basically what you do is S&P is looking at the 11 sectors within the Standard & Poor's 500, because all of those individual companies that are in there can be placed into one of these sectors. So they take all 11, and then what they do is they give them a value score. And I am not a math geek, do not mean how they do all the calculations on their value scores, but it is something that they do analyze. Then what they do is they take the 5 sectors that have the 5 highest value scores, and they rank them by their momentum score. And the top 3 end up being the sectors that are going to be used for this half of the year for the sector rotator strategy. So for instance, for I wrote it down, where did I put it? For the first half of 2024, if your client is in the sector rotator strategy, the 3 sectors are energy, healthcare, and real estate. So those are the energy, or the sectors that include energy, healthcare, and real estate that would be used in the calculation for the sector rotator return. And what happens is, whenever those numbers end up performing then at the end of the year, that is then applied to a participation number, and that is what the client will receive for their earnings for that fund for the year. So it's kind of interesting. I personally, I think it's kind of cool because it doesn't have a cap. So I like the unlimited upside potential. You just want to keep in mind that it is, like I said, a subset of the P500, because they're only utilizing 3 sectors at a time.
Kristi, quick question. If I have a client who already a deferred annuity with us, and say they're allocated to one, are they able to change their allocation, you know, mid-plan, like if they're in
on anniversary?
On anniversary, okay.
On anniversary.
And then
Yep. So what? Go ahead.
If they decide, let's say they want to roll into, because now we have higher percentage rates than a few years back, would they be able to, obviously without churning, roll it into another, I guess the same annuity or same strategy of annuity, without a market value adjustment?
No. Let me answer the question, because that's a great question, Alonzo. So there's 2 charges that you have to be mindful of: surrender charges and MVA charges. We will internally, if you replace, let's say, one index annuity with another indexed annuity, we will waive the surrender charges, assuming that the surrender charges on the new contract are at least that much or more, which that's not the problem. It's the MVA. There is a market value adjustment that, depending on how the rates are where you went in at your original contract and where they're at today at time of replacement, it could be a positive or a negative, and the MVA will apply, good or bad, for an internal replacement. So let me be clear that I say that again. The MVA will apply whether it's good or bad, because remember, it can have a plus or a minus depending on the calculation that would be applied at internal replacement. But Alonzo, we would waive the surrender charges. Remember, there's 2 pieces. MVA is one thing, surrender charges are another. So we would waive one and not the other. But that's a great question.
Thank you.
You betcha. And just so you know, that was something that the company had to get their arms around, just kind of as a side note. Again, we weren't even barely selling annuities how many years ago? And then when they started to come back into favor, we started to get that uptick in sales. And then, like you said, Alonzo, once we made some internal adjustments to some of the payout factors, it made it even more competitive. So for those of you that have contract holders that maybe, like you said, in lieu of churning, if there is a policy provision that is more advantageous and a replacement makes sense and it economically makes sense for the client, was something we had to get our arms around. So again, it's kind of just our internal guidelines, because they are ours to control. Because if that money was to leave the company, then you would be getting hit with surrender charges and a potential MVA. It's just internally what they have analyzed is we can waive the surrender charges, but again, if an MVA is applicable, we would have to charge the MVA. Or the reverse. I've had a couple of them, believe it or not, there was a positive MVA. They actually got a little bit of a bump up, and they did the internal replacement. So I want you to know that both sides of that coin are true. Okay, so let's look
Kristi,
go ahead.
Kristi, quick question
Yes,
before
Charles.
you move on. In terms of the rebalancing features, that you mentioned on the contract, I know you said the policy has to be on an annual basis. You can do the rebalancing, correct?
Yes, you have to be in that index account for the full year. So because the measurements are typically 1 year periods, so they don't let you, you know what I mean? They don't let you make that change 6 months into the year. You have to do that on anniversary date of the indexed account.
And how is that done? And can we set it up where it's automatic, the rebalancing, or do we have to call a customer service, or how is that change done?
Yeah, that's a great question. This is how I believe the answer, Charles, because that's an enforced question. I would want to verify this. I don't think any of that is done automatically. I believe everything, according to customer service, would have to be done via a phone call, a form, some kind of direction. I don't believe there's anything set up, because the automatic, Charles, is just to renew for what you came out of. If you were in a 1 year point-to-point S&P 500, that's what you're going to go into.
Okay, thank you.
You bet. On the accumulation 7, now remember we have 2 different index annuities. This is the accumulation 7. The surrender charge on this product is 7 years. That is the basic contract. It's a 7-year contract. But if you had a client that wanted to purchase an optional 5-year surrender charge rider, that would cost them 15 basis points annually, and they would shorten their surrender charge period from 7 years to 5 years. So please keep in mind that it's a base 7-year contract, but if you had a client that needed it to be only 5 years, they could do that, but that would be an annual cost to their account value of 15 basis points. The accumulation 7 does is offer a base death benefit and then an optional death benefit for purchase. So the included death benefit basically says at time of death, assuming it's in the 10th policy year or later, we will guarantee that the death benefit is equal to premiums less withdrawals plus 110% of their interest credits. So we give them a little bump up of earnings at death, assuming the death occurs year 10 or later. So that's a free rider. That doesn't cost the client anything. It's inherent to the contract, and know that gives them a little bump up at time of death to their beneficiaries. Now, if they're interested in an enhanced death benefit plus, for a mere 10 basis points, it's actually a very low charge. At time of death, we would pay 140% of interest credits, assuming the death happened year 10 or later. So let me give you a good sales idea. If you have, let's say, a life insurance client who is uninsurable, they've been declined, they have a condition or something that warrants an uninsurable on their life insurance needs, this is something you can think about. If it's a client outside of the state of New York, we do have the Enhanced Death Benefit Plus rider on the Accumulum 7. Now, mind you, the client would have to, obviously put, premium dollars into this contract, but know that as long as the death occurs year 10 or later, whatever they've made in interest at death, the beneficiary gets 140% of those credits, obviously plus their premiums paid. We're not just paying interest; they get their principal too. But my point is, it's a nice step up at death. Keep that in the back of your mind as a potential sales pivot if you have a client on the life side that's uninsurable. So the income 10, I'm going to start talking about that indexed annuity. This is going to be an income annuity. This is going to be something where clients will be interested in this contract if they are looking for growth potential and guaranteed income that they can't outlive. This is, I personally own Income 10. I think it's an awesome contract. I actually, when I worked for Allstate for 22 years, and let's just say they didn't really want my employment anymore. So, what do you do? 10 years at Ameritas, I love it, but I was let go from Allstate. I had a 401k there. Well, I know that if they didn't want me as an employee, I sure wasn't going to keep my money in my 401k there. So I did take a portion of that and I rolled it. I did a rollover from my 401k into my own IRA with an income 10 here at Ameritas. And why did I do that? Because I knew there was a portion of my retirement dollars that I would want guaranteed income. So that's why I did that. So with the income 10, there are 3 phases. There's the accumulation phase, which that's where you're building account value, right? That's where you're building your benefit base. You're not taking any type of income during this point in time. Like for me, I'm in my accumulation phase right now because I'm old, but I'm not ready to retire yet. So I'm still in my accumulation phase. Then what happens is you hit your withdrawal phase. Yes, Alonzo?
I said you're only as old as you feel.
Aw, thank you. Well, I feel 100, so I don't know what to say about that. No, I'm teasing. Then you hit your withdrawal phase. This is when the owner initiates their lifetime withdrawal benefit. This is something that is triggered by the owner of the contract, and you turn it on when you are ready to start receiving that predictable supplementary retirement income. Then, if you live a nice long retirement life and all of a sudden now your lifetime withdrawal benefit is still clipping along and your account value is actually now down to 0 because you've exhausted all of your funds that you, deposited plus earned in that account, guess what? The lifetime withdrawal benefit, it continues because it's guaranteed for your lifetime. So even if your account value reduces to 0, your withdrawal benefit is still paying as long as you're alive, or if you have a joint payout, at least one of the owners is still alive, and we'll talk about that. So it's an awesome, awesome contract. Here's how it works. If you pick one of our 4 income riders, so the withdrawal benefit riders are the income protector, the income builder, the protector plus, or the builder plus. We have those options on a single life expectancy or a joint life expectancy. The charge for the protector and the builder is 1%. that does come out of your account on an annual basis. And if you were going to pick the plus version, and I'll explain what that is in just one sec, that would be 1.1% deducted out of your account value each year. So basically what the plus does is it gives you what I call a doubling effect. So if me, or I actually got the plus version on mine, so it's for me and my husband. If either one of us becomes unable to do 2 of the 6 activities living, it would actually double our income while we are unable to do the 2 of 6. It only has to be one of us that is unable to do the 2 of 6. It doesn't have to be both, because I have a joint option on my annuity. If you were a single individual, obviously it would be based off the single individual. So what happens is you get that double effect until you exhaust what they call your benefit base. And once your benefit base becomes 0, then it would revert back to the original single amount, not the doubled amount. So basically, for just a little bit more in charge, you've got that opportunity to get even a higher income stream. And I think that's pretty cool. Now, with the 2 riders, we have a 7% roll up on the protector. So what that means is for the first 7 years of the contract, you are guaranteed a 7% roll-up rate on your benefit base. If you don't initiate your income stream during that first 10 years, starting in year 11, it will still roll up, but not by the 7%. It will grow according to however you're allocated. So your interest credits is what will increase your benefit base starting in year 11. With the builder, this one has a 3% roll-up rate, but you also get twice your interest credits. So if you feel over the 10 years that your allocation to your index accounts are going, to prove some pretty good returns, the builder might be something that you're interested in, because you're always going to get 3% on the roll-up, but we'll add that to twice your interest credits. So that's kind of a neat option as well. So at issue, you have to pick. Remember, there's 4 riders, and I'm going to go back screen, actually 2 screens. There's 4 riders: the protector, the builder, the protector plus, or the builder plus. This is a choice that has to be made at issue, and once you make it, that's what you get. That is what the contract is priced at. That is the benefit you will receive. Protector, 7% roll-up. Builder, 3% roll-up plus twice your interest credits. So very nice withdrawal benefit. And then when you're ready to actually initiate your lifetime income, we take whatever your benefit base is at that time, and we apply a lifetime distribution factor. Now, I'm going to pause here for a second, because this is what Alonzo was asking me about. We repriced a lot of our lifetime distribution factors to make them higher. So that's why, like for me, I'm on the old pricing. I have not looked at doing an internal replacement for a couple of reasons. I actually have a negative MVA on mine, and I'm close enough to retirement that I just didn't think, I could possibly make up for that deficit in the extra distribution factor, but for me personally, it wasn't that big of a change. So I am very comfortable with where I'm at. But like you said, there might be some situations where if it is just a very small, or I'm sorry, not a small change, but a larger change, it's obviously something, like you said, Alonzo, that might be worth analyzing to look at if a replacement makes sense. It's not always going to make sense, I can promise you that, but it might, absolutely. With our Income 10, please note that you can run an illustration on Life Designs. It will give you the 4 different income rider options that I mentioned. Yes? Is there a question? And then if you wanted to, there's also a calculator available on Producer Workbench that can help you calculate what the withdrawal benefit would be. If you weren't in an actual illustration, you could just look at a calculator and say, if I put this much in and I wait to take the money in this year, how much would that income be? That's a calculator that's on Producer Workbench. The other thing I want you to know is these index annuities, the applications are available in eApply. So you can make this a much more streamlined process because you can do a fully electronic application for your Income 10 and your Accumulation 7 applications. Other thing I have to make sure I mention is that there is required annuity product training prior to submitting an application on both of our indexed annuities. So you do need to go out to Reg Ed. There is a link I can show you in Producer Workbench. That is something that does have to be completed prior to the submission of the application. So it's required product training. That, you call me, call the sales desk. We can definitely assist. Let's open it up for questions. I'm going to quit doing a screen share for a second so I can bring up Producer Workbench. What do we have for questions?
What are the tax consequences of the way you fund this IRA? It's an IRA, right? Sorry, annuity.
Well, it can be an IRA, sure. When you do an annuity, it could be non-qualified or qualified. So tax consequences, are you just talking about once you start taking distributions?
Correct.
Are you taking off of a withdrawal? What kind of distributions are you taking? Is it just a normal partial withdrawal? Are you surrendering? Are you doing a withdrawal benefit?
Well, in general, let's say it's not an
In general?
In general, and not an RMD. Basically, just taking
just a non-qualified distribution.
Right. Annuities
work where it is what they call the LIFO accounting rules, where it's last in, first out. So basically, any interest that you are earning on your non-qualified annuity at time of withdrawal, that interest comes out first. And that will be 1099 income to the policy owner. And once you get through your interest earnings, once you get to your actual principal, well, then that's different. That's after tax dollars. You could get back to your principal with no tax consequence. But all earnings do come out interest first.
Okay.
Yep.
I actually
and that's one of the things on a SPIA. Oh, go ahead, Alonzo.
No, finish.
Oh, all I was going to say is that's the different tax treatment on an immediate annuity is different than a deferred annuity. So I was going to say, if your client purchases an immediate annuity with non-qualified dollars, there's something called an exclusion ratio where they get a portion of their principal and a portion of their interest in every payment. So
Right.
It's not all of the interest getting hit at one time. It's a portion. Yep, that's all I was going to say. What were you going to add, Alonzo?
So I was going to add, actually, I had a question that I had two questions actually now. Thank you, Derek, for reminding me of my second. My second question I'll ask.
Derek's a good one. He always has good questions. What's up?
Definitely. It has to do with RMDs. I know RMDs are, I believe, going to 75 next year. And has the company thought about that? Are we readjusting, interest rates or things like that? Or is that just kind of something we're going to have to kind of wait until we see what, like, the climate of the economy does?
Yeah, that isn't something that, yes, it's on everyone's radar screen, and the annuity product team obviously is aware of it. I can't say I've got really any clear direction on how that's going to change anything right now, but I know it's going to be, it's something we're going to have to take a good hard look at. I'm glad I'm not an actuary, because that is beyond my scope.
I can answer that because they
Yes,
just
Charles.
sent my mother a letter from customer service describing describing the whole RMD changes with the
Oh, good.
new regulation. Yeah, they just sent that's why I know they just sent my mother a letter, because she called me for me to come over there and explain this to to her with a form.
And
So
you're like,
yes,
let me read the letter first.
yeah.
Oh, I didn't even know they
What
did
letter?
that.
Yeah,
No, thanks
what
for telling
letter?
me.
And
Yeah,
then I
that's
had to
right.
Yeah,
call. So
what
yeah,
letter?
so they are sending them the letters, Alonzo, from customer service with the new rules and the changes and the Secure Act, a good explanation, and also there's a form and tells them how much they have to take out, like minimum. So yeah, customer services is on top of that. There's really nothing you have to do.
Okay. And then my next
Well,
question.
and I thought maybe Alonzo, I thought maybe you were asking how the company pricing is going to change to accommodate that change in RMD. So yeah, I had actually heard that we were notifying policyholders. I didn't know it was started already. I thought you were maybe getting more at how's that going to change from a company perspective as far as pricing and things like that.
That was
So what was your other question?
Was the pricing. But then my next question is on the SPIAs. I noticed that we have issue age 0 to 85. And so my question then begs, with tax consequences on someone who's obviously not, 59, and like my cousin just had a baby. So, if I were to put a SPIA on my new niece, wouldn't that cause tax issues because she's under 59 and a half?
SPIAs are not, hold on a second. There's no deferral on the SPIAs. So the 59 and a half, if you just buy a SPIA outright because you're not deferring any income, yes, there's still tax consequences, but there's no penalty.
Okay. Is it more like, I guess, do we even sell Coverdales anymore in the industry?
I don't know.
Okay.
Now I have not heard about that in years.
Yes, they do, Alonzo.
Okay. I'm
They
just
still
trying.
do, yeah.
I'm trying to think of a good gift for my little baby, gonna be goddaughter.
Oh. All right.
Kristi,
I'm
will
going
you
to go
show
to,
us how to
do
do
we
the
have,
illustrations?
yep, I was going to go to
Okay.
producer workbench next. That's what I was going to say. If there wasn't any other questions, I was going to go off video and go back to a screen share. So let me get back to my screen share. Okay. So, and I will get to an illustration, Charles. I just wanted to point out a couple quick things because this is a rate-driven product, right? I mean, yes, there's benefits and features, but let's be honest. At the end of the day, people want to know what the rates are. So what you do is on Producer Workbench, you go over here to Product Portfolio and you drop down to Performance and Rates. Once we click on that, we go to Rates. And then there's all these different rate reports that we can look at. If you remember, I was talking about the Compass FPDA New York. I told you that's in the annuity rate line. And this is going to be a really ugly interest rate report, but I want to show you where it's at the March rates, because Charles, I think you asked me how long that rate is for. And let me blow this up because you're never going to be able to see this if I don't blow this up. So here's what I was trying to point out was, here's the product, the Compass FPDA. This is in New York, and you know I'm on the right line because you can see all these little NYs over next to the company. So you know I'm in the New York product. So if you give us, the rate band is only 50,000 on this one. I'd have to double check and look, or is it 10? Hold on a second. Compass rate band 50, yeah, 50,000. That's what I thought. So new deposits less than 50,000 get this 3%, which is right there, and then minimum guarantee. This is what I was talking about. That 3% is on the contract. And then if you had over $50,000 of a deposit, that's at 3.3%. for the year. But then remember, the guaranteed minimum is still 3. But because you gave us 50,000, you're actually earning 3.3 for the first year. So that's the rate line. And then if we went and looked at the cap rates, we could click on the cap rate report. And this one's a little bit easier to read that. So here's the equation 7. Remember, this one is not income focused. There is no GLWB option. This is accumulation only. So you can kind of see here's all different index accounts and all the different band amounts. So the more you give, the higher your cap rate. So I just want to make sure everyone knew where to go look up interest rates. And then to Charles' request to run an illustration, you click on Create an Illustration. We're going to go to Launch Life Designs now. And I bet I'm going to have to sign in because I've been out of Life Designs since I've been chatting with you all. So let's see if I can get into it.
And also, Kristi, you mentioned there was a calculator. I
Yes.
wasn't aware of the GLWB
Oh, yep.
calculator. You can
Yep.
show me where that's. Okay.
There is. Yep. Just search calculator on the toolbar, because to be honest with you, the path escapes me. So if I don't know the path to something, I just put it in the search bar. That's just my little producer workbench tip. And the very first thing that comes up is our calculators. So this is product specific. So we're going to go to income 10. And then you would put in these parameters. So how old the person is, what kind of premium they had. You can assume a growth rate, and then it will give you what the actual income stream would be if you chose it. Otherwise, you can just see all the factors. This is kind of a neat way to see all the distribution factors at different ages. You can see all the different ones.
So if a client said,
yeah,
this is great. So if a client says they want to retire with, $75,000 annually, this will tell them how much they need to put in.
You can back into it
at today's dollars.
Yep, you can back into it. Yep, you can back into it. That you can do. And then to run an illustration, you just click on Create an Illustration, Launch Life Designs Now. Let me put in my home office code here. And clients and cases. I think I was just working on it. Yeah, this is a New Jersey 55-year-old, so I'm just going to use this gentleman because the product will be available because it's New Jersey. So we're going to go select annuities. Once we select annuities, we have to select the product. I'm going to do an income 10 for him. Let's say he's got a rollover amount. We'll give him $200,000 to roll over. We're going to ask him if he wants a single lifetime withdrawal benefit or a joint. We'll just go ahead and pick single just for sake of less clicks. Then from here, you ask, you get asked which GLWB you want. I'm a fan of the Protector Plus, so I'm going to go ahead and just use that. And I'm going to say he's going to retire at 65, so I'm going to start the lifetime withdrawal benefit in 10 years because then he would be 65. Pick your allocation by clicking on the allocation button. I don't know why it always defaults to the fixed account. So we'll put it in the S&P 1 year just for, say that.
So let's do the sector. You turned me onto the sector rotator now. I try to put everybody.
Oh, I do like that. Yeah, I do. You know what? I'm old school. I still like just the good old 1 year point to point. But I like the sector rotator as well. I have mine split between the two. I have some in just the regular 1 year point to point. I did about a 50-50. About a 50-50 split is what I did. And we'll give it a second. Since I'm doing a screen share, it's probably just a little bit longer.
So Kristi, when you do the split like that, is there more fees, or is the same fee, or is it additional fees to split it?
Same fee. Nope.
Same fee?
Nope. Nope.
So if you did four, okay.
Yep. It's not by account. It's not by account option. It's just per contract. So yeah, it's just I pay 1.1% every year out of my account. You know, that's what I get is a 1.1% deduction. And I have two funds in mine. I could have 4, I could have 6, I could have 1. It's all the 1.1% deduction. That's a great question. Now, there's a couple of things that I really like about our annuity illustrations. And one of the things I like is it almost gives you a brochure as well as an illustration, because there are a lot of great features that are bulleted on the illustration. So don't just gloss right over this. There's a lot of good contractual provisions listed on these pages. I like this page. It tells me how I'm allocated for the illustration. So this 55-year-old gentleman, I put 100% into the S&P 500 one-year point-to-point. And for his contribution, it's right now a cap rate of 7.9. You get your last 10 years of return averages, your lowest 10-year period, and your highest 10-year period. This is basically giving you actual change in the S&P 500 with the current cap applied. So you can kind of see we're really tight with all of this. You know, the lowest, the highest, there's not a big variance on this one. Alonzo, I know if we pick the sector rotator, we're going to see a little bit more of a variance, but this just happens to be the S&P one-year point-to-point. So this gives you some averages. This is the aggregate. So if I chose more than one index option, this would aggregate the return of all that I chose, and then you get an info page for each index that you pick. I only picked one. That's why my pages are identical. I wanted to get to kind of the meat and potatoes. So here is our 55-year-old gentleman putting in $200,000. I chose the 7% roll-up. So that's what he's getting on this. And then I turned the income on at age 65. So his distribution factor when we applied the income stream was 6.61%. You get that of the benefit base, which equals a little bit over $24,000 for him, and he will get $24,000 a year guaranteed for the rest of his life. If he becomes unable to do 6 activities of daily living, that $24,000 becomes $48,000 until the benefit base becomes 0, and then it would revert back to $24,000. And I said that wrong, not the benefit base. The account value has to become 0. Then it reverts back to the original. I said benefit base. I should have said account value. So yeah, so that's how you run an illustration. And yeah, what do we have for questions? We've got a few minutes left. What can I show you or answer?
You got me for once. I have no questions.
What? That's not right. You always have good questions. Derek, you always have good questions too. You always come up with something good to ask me. What else? What else is on your mind?
Well, it's not a question, but can you explain to them where you see the minus when you, if you go up a few pages, like you can see there was a minus. Yeah, you see there
for the index return.
Yeah, in the green you see there's like in year 2 there's a minus 38.49, and then
oh yeah.
Like, can you explain that?
That was
can
ugly.
You explain how to explain that to a client?
Well, that's what the S&P 500 did. It plummeted. I mean, that's the 08 crash. And what's great about this type of a product is you will not get negative returns because of negative market performance. So even though the S&P 500 dropped 38%. Yeah, ask me how my 401 in 08. It took a hit. So did everybody else's. But if you had just been in this contract, yeah, you wouldn't have made anything, but bigger than that, you wouldn't have lost anything. So that's how I describe it, is the market goes up and down. That's just the nature of the beast. The market goes up, the market goes down. What an index annuity does is it gives you upside potential where you get to participate in some of those gains, but you don't have to participate in the losses because we give you a zero floor.
There's a floor, yes.
Yeah, zero floor. That's why you see the negatives, or I'm sorry, the zeros next to it. It's as simple as that, Charles.
It is simple like that, Charles.
Participate in the ups. It is. It is. Participate in the ups. You don't have to participate in the downs.
Because you got the floor.
That's a great explanation. Derek, you, me, and Charles are very familiar with this, but we do have some newer agents who might not have understood how to explain that. So great question, Charles.
I brought that up because my father didn't believe me when I was trying to explain this to him. I had to actually show him in writing. That's why I said that's why I said point that out, because he did not believe that at all. He was skeptical. Like, there's no way, that's not possible.
Well, because it sounds too good.
Yeah.
Well, it's too good to be true. I like. Here's a tagline for you. Here's a tagline. Zero is your hero.
Mm-hmm.
Zero is your hero. And people will go, what? What do you mean zero is my hero? That doesn't sound right at all. Then you can show them on something like this where there's negatives, show them the zeros, and then say, see what's your accumulated value? You know, now the only thing you would lose, I want to be honest, if you don't make, let's be very, very crystal clear.
Mm-hmm.
If you don't make anything in interest earnings, so you have a 0% year, how do you still lose a little bit of account value? What are we going to do still? What do we deduct for in the income 10? What's still going to be a deduction you have to pay for?
The 1.1%.
The 1%. The 1% for the account.
Yep. I just want to be clear. I'd be clear. You will still get a deduction. That's why on that green chart here, Charles, it went from 204 to 202. There's still a deduction because you have to pay for the withdrawal benefit.
Right.
That's the 1.1 every year.
Imagine losing that 38% and then still having to pay the fee.
I know.
That would be problems.
That's what's great about this.
I will never forget.
That's what's great about this product.
That was horrible. Oh, I know. I know.
Great. This
I love
protects
it.
you from the market risk. Like, you don't have that, in the variable or in the margin accounts, because they would have to suffer those losses. So this protects the clients from losses, right? Then it protects you from the longevity risk. I don't think we really caught that. This is a
can't outlive it.
where
Yeah,
you
cannot outlive it.
You cannot outlive your money. So if your clients live to age 90 or they make it to 120, they're guaranteed to not run out of money. Unlike if you have money in a margin account or a brokerage account on a bank account, those funds can be depleted. This is guaranteeing that. And if you set it up in the qualified plans, right, then now you can take advantage of the tax. You can help people adjust their income down to where they pay less on a little less on taxes. So it's a wonderful product.
Charles, I like your terminology.
I agree.
I like longevity risk. I like that our terminology.
Yeah, that's what that's the longevity risk. Yeah, living too long, because with the way medical and that scares people.
It is.
Those terms you certified retirement counselors use.
Yeah, that's a CRC term right out the book.
Yes, indeed.
That's a certified retirement counselor plan. Great. So Kristi, we're done today. So as always, we really appreciate you. Speaking of qualified retirement plans, maybe we can get someone from the retirement or advanced markets, or if you're willing to come on and show us how to set up. Because I know a lot of agents think they don't, with your fixed license, you actually have, with this product, you can set up like traditional IRAs, Roth IRAs, simple IRAs, SEP IRAs. Like, we can actually set up these accounts, which is something between now and April 15th, is something that we can take advantage of, setting these accounts up to help clients. So I don't know if there's someone from retirement plans that can come on and
it wouldn't be probably retirement plans, because they want to talk to you about solo 401ks. They don't do so much the individual ones, but you know who does is advanced planning. And I'm trying to think, didn't you work, which one of our advanced planning gentlemen have you worked with?
Well, we had
I
Troy
know you worked. I
Branch,
don't know.
Troy Branch, and Wendell Stallings.
Troy.
Those two,
Yep.
Troy Branch
Yep.
and
Wendell.
Wendell.
Yep. Those two. Yep.
One
I'm
of those
trying to
two?
think.
Okay.
Wendell. Maybe Wendell. I'm trying to think if one of them would be. I mean,
They
that's
actually
their.
have something going on tomorrow.
That's their purview.
They actually have something going on tomorrow. Using the life insurance as part of a qualified plan. I'll
Oh, for
send out
qualified.
that.
Yep, for qualified
Yeah.
plans.
Yeah,
Yep.
something
But
going on
I'm
tomorrow.
thinking maybe we could, if you wanted to reach out, if you can get one of them to commit, I would love to jump on the call. I mean, I would need you to get like Wendell to do it, because
Okay.
again, I know enough to be, I mean, I know what an IRA is, but that's just more in their,
Yeah,
I think more in their
specialty.
bag of tricks.
All right.
Yeah.
I'll reach out
Yeah.
and definitely invite you onto the call. All right.
I wish you would. I think that would be a great call.
Okay. With that said, I have to run. Hey, thank you, everyone.
Okay.
This was a great session, and I'll send out the recording.
Thank you.
All right. Thanks, everyone.
All right.
Have a good day.
Thank
All
you.
right.
Thanks,
Take care.
Kristi.